I had a question in Telegram about what is the best S&P 500 ETF. And the answer is, well, it depends. Okay, so the short answer to that question of what is the best S&P 500 ETF that I could suggest is it depends. And let's talk about the long answer. The long answer is it depends on what you're really investing for, what stage in your investments you're at, what kind of investor you want to be. It really depends on your investment style and what you're looking for. There are a lot of S&P 500 ETFs, and let's go through the ones that are my favorites, and I'll tell you why each one is different and why they depend on your trading style. First is VOO. VOO is a pretty generic S&P 500 ETF. It is a basket of companies such as Apple, Microsoft, Amazon, Tesla, Google. It gets down into some healthcare, some energy companies, things like that. You can see the sector breakdown here, what it's invested in. So this fund is basically a pretty broad spectrum of the S&P 500. Now, why would you ever want to invest in this one? This one gives you broad access to the S&P 500. You invest in this, you're expecting the S&P 500 is in general to grow. This is a growth ETF. You want all these companies that are part of this to continually grow, which increases your share price, and it continues to go up over the long term. This is a long-term investment strategy. When you get into VOO, this isn't something that you jump into and bail out of in a year or two. This is something that you're looking to put into your like 401k or Roth IRA or something like that to grow it over 10, 20, 30 years. It's got a very low expense ratio of 0.03%. It's got an okay dividend of 1.64% that's paid quarterly. Let's see. It's pretty far on the low side over the last 52 weeks. It went down to 319. It's probably a great buy then. I guess we'll see what happens in the next 6 months or so. It says risk is average and above average return. Now you can't really see that return here because last year everything has gone down almost, well, except for energy over the last year. But looking at the last 10 years, you've gone from 130 or so to 344, 345. So it's more than double than the last 10 years, which is good growth. And that's what you're really investing this for, is the growth. So that is a growth index or ETF, exchange traded fund. The next one that and just as a disclosure, I actually own shares in all of these. The next one is SPHD. This one is a high dividend, low volatility ETF. Now you can see this over the last year. This thing has almost been flat. It's lost, a few dollars per share, but in the scheme of, the stock market and S&P 500, this is fantastic. It's only down a few percentage points over the last year. It's great. Let's see, it still is risk is average. You're still investing in basically, these big holdings in the S&P 500. They're going to be skewed more towards those that pay out dividends, high dividends, such as like AT&T, Dow, things like that have been paying dividends for a long time. It's just not volatile, and it pays 3.93%. Now, let me tell you why that is incredible, especially for if somebody's retired. Traditionally, the rule of thumb is once you build up your retirement, you have $1 million or $2 million sitting in the bank, you pull out 4% a year to fund your retirement. And then, by the end of your being retired, you've gone through your retirement funds. Now that's kind of a risky strategy because who knows how long you're going to live, and it'd be nice to pass something off to your create that generational wealth for your kids or whoever you want to pass it down to. This way, instead of withdrawing 4% every year, you get 3.93% every year, and that's paid monthly. So instead of taking from your principal, you're just pulling out dividends at that time. So you could basically live off of the dividends. At the end of your life, you'd still have this nest egg sitting there that's been just paying out dividends. And hopefully you could just keep reinvesting in a lot of those as you went. But a lot of people are relying on things like this to really basically retire early, because they just build up this fund as fast as they possibly can and live off the dividends, which is entirely possible. The best thing about this is it's pretty flat. Even if we look at the chart over the last 10 years, we can see it's grown quite well. $24 up to $42 that it is now over 10 years, while paying all those dividends. That's a pretty good investment if you're really just looking for dividends. So that's another one. The next one is a Global X S&P 500 covered call ETF. Now these ones are pretty new. They've been around for 3 or 4 years. This one is XYLD. And if you look around on YouTube and everything else, people talk about QYLD all the time. And I don't know why it's so popular, because I actually really love this one much better. This one actually, it seems to have better growth over the long term, and it still pays out that super high dividend rate. They do this by taking the holdings in all of these companies basically every month. They take all the holdings and create covered calls, which I could do another video on about how covered calls work. But it's actually an investment strategy that's kind of like trading that, gives you a percentage every month. So you're going to be paid out every month on this. It's 13% annual dividend yield. Now the expense ratio is pretty high on these compared to the other two. You start with VOO, and it's just a fund. The next one is the high dividend. They've got to pay out those expenses every month, so that one's the expense ratio is a little higher. Then this one gets up there because they're having to do these covered calls every month and pay out every month. As you can see, it's not that risky because you're still investing in these companies. It's got $2 billion in assets in the fund, and the return rate is average because of the dividends. Now the cool thing about this one is if you look at the chart over the last 10 years, it's actually been flat, which is really good. It's actually gone up and come down, gone up and down, and it's come down to almost where it started 10 years ago, which for such a high yield dividend is pretty incredible. So that is XYLD. And then you've got another one, which is the Global X S&P 500 covered called and growth ETF. So this one's very similar to this one, which is XYLG instead of XYLD. This one does like a half and half strategy where you're going to get not as much of a yield, but they're also leaving half of the fund to be used as growth. So you can get a little bit of growth and also a little bit of the dividends as well compared. Obviously, because of this management, it's still going to have a high expense ratio of 0.6%. But yeah, it's going to have very, technology heavy. It's very similar to VOO and the top 10 holdings, honestly, because they're really focused on growth as well as doing those covered calls. So I want to talk about, before we end here, those are my top 4 ETFs for S&P 500. So we have VOO, If you want growth, you want low or high dividends and low volatility. This one's a very stable dividend, which is SPHD. I really like that one. If you want the high dividend yields, which are based on covered calls, that's XYLD. And then if you want like kind of a blend, you could do XYLG. Now, just as a disclaimer, I do have an account on M1 Finance, and XYLG, they do not have it over there at M1. Just as a disclaimer. Now, while we're talking about these covered call ones, I want to talk about why I like the XYLD versus QYLD. If you go on YouTube, there are people that like their whole channels are based around QYLD. QYLD is a covered call ETF that is based on the NASDAQ. And I'm not sure why it is so popular compared to like XYLD. Let's look at the summary of QYLD, and this is the NASDAQ one. Same expense ratio. Your dividend yield is pretty much the same, 12.96 versus 13.3, so about 13%. Yeah, they say risk is below average. I think the risk there is actually, I don't agree with that. Yeah, it's just a different setup with the NASDAQ one. But this is where I want to show you where I like the XYLD much better. This is the chart. I mean, they've been going through since 2014, so about 8 years. You know, this thing was up around, $26, and now it's at 16. I don't know. I don't want to like lose tons while I'm doing these covered call ETFs. But I don't want to see, I just don't want to see this type of just drop. And, yes, I can understand, pandemic happened here. We've had lots of things happen here. But if I look at the same chart for XYLD, starting roughly the same time, it's relatively flat. We're actually kind of bouncing off the bottoms of where it's been trading at. So that's why I really like XYLD. It's a very, very similar dividend profits, same expense ratio. You're still, covered by a basket of funds. It's based on the S&P 500. So I'm not sure why a lot of people really push QYLD over something like XYLD, but that's up for them to, whatever. Anyway, guys, those are my 4 favorites. VOO, we have SPHD, XYLG, which is a blend of kind of growth and the covered call, and XYLD, which is just covered calls. So the long answer is it depends on what your trading style is and what you are investing for. Anyway, guys, hopefully that cleared things up on my favorite S&P 500 ETFs. I do hold all of these except for the QYLD. I didn't see why I would want to, since this is a very comparable and actually better fund. If you have any comments, leave them below. If you like the video, give it a like. Thank you for everybody that has subscribed, and we will catch you on the next one.